So you want to put your money to work, like get your feet wet in the world of investing. It's a big step.
Yeah, definitely a big one.
And I can see why you'd want a good map before you dive in, which is what this deep dive is all about, guiding you through all those different investment options, especially since you're just starting out.
Yeah, for sure.
We've got some great sources lined up, really structured, super helpful, I think.
What I think a lot of people don't realize is how powerful idle money can be. So many people just miss out on the opportunity to make their savings actually work for them.
It's like your money's just sitting there on the sidelines instead of out there scoring goals.
Yeah.
One thing our research really emphasizes is having a plan. It's tempting to jump right in.
Oh, yeah, for sure.
But a clear plan is essential.
It's like setting off on a road trip with no map or GPS. You might end up somewhere, but probably not where you wanted to go.
Exactly. And that brings us to the first stop on our investment journey. Defining your goals. What are you hoping to achieve?
Yeah, what's the end game here?
Our sources mention some common ones. Saving for a big event, like a wedding or your kid's education. Or maybe thinking long-term, building a retirement nest egg.
Yeah, planning for the future.
What feels right for you?
It's all about matching up your strategy with your goals. Are you looking for those quick wins? Or are you more of a slow and steady person, letting your money grow over time?
Which brings us to our next signpost. Time horizon. Our sources spend a lot of time talking about this, the difference between short-term and long-term investments.
Right, because those are two very different approaches.
And how that impacts your overall approach.
Yeah, definitely. Imagine you're saving for a down payment on a house, like in a year or two. That's a short-term goal, totally different strategy, compared to someone saving for retirement, like decades down the line.
Short-term, long-term, finding the right fit. This next part always makes me nervous. Risk tolerance. Any advice on how to deal with that?
Oh, it can feel intimidating. But just think of it as figuring out your comfort level with potential ups and downs. Because every investment has some level of risk, and some have higher potential rewards, but also a higher chance of things not going to plan.
Yeah, our sources really stress the importance of only investing what you can afford to lose.
Absolutely.
Don't want to put yourself in a risky spot financially.
It's all about balance. Higher risk can mean higher returns. But you need to find that sweet spot where the risk level matches your situation and your peace of mind.
Once you've got a grasp on those three things, your goals, time horizon, and risk tolerance, it's time to explore the different ways you can actually invest. Our sources break down a few options. It's like choosing your vehicle for this investment journey.
Yeah, I like that analogy.
We've got direct trading, managed portfolios,
Yeah.
digital portfolios, and social trading.
Each with their own pros and cons for different types of investors.
Let's start with direct trading, taking the wheel yourself. The sources mention platforms like Made of Trade, where you can start with a pretty low minimum deposit, just 10,000 shekels.
That's a great starting point,
Yeah.
especially for beginners. It's important to be aware of the costs, though. Things like trading fees and commissions, which can be anywhere from 0.1% to 0.07% per share, with a minimum of 2.5 to 5 shekels per transaction, like our sources point out.
Yeah, those fees can definitely add up. It's something to keep in mind. Direct trading gives you a lot of control, but it also requires more knowledge and effort.
For sure.
Now, for those who prefer a more hands-off approach, there's the option of a managed portfolio.
It's like having a financial co-pilot, a pro manager who takes care of your investments, based on your needs and risk tolerance. However, our sources mention this usually needs a larger starting investment, often from 300,000 shekels, and it's best for a medium to long-term strategy.
So maybe not the best for someone just starting out with a smaller amount. That's where digital portfolios come in, right?
Right.
Our sources highlight how user-friendly and accessible they are with a lower minimum investment of 25,000 shekels. And the best part is, these portfolios are still managed by experts, so you're not totally on your own.
Yeah, it's a good balance between convenience and guidance, especially for new investors.
And then there's this interesting option of social trading. It's almost like following in the footsteps of experienced investors, wouldn't you say?
Yeah, kinda.
Our sources describe it as mirroring the strategies of successful traders.
It's a fascinating approach. What I find really interesting is the transparency. You can see exactly what those experienced traders are doing and learn from their decisions. And of course, the lower risk is a big draw, especially for beginners.
So many different paths to choose from. Now that we've gone over those, let's talk about actually taking action.
Yeah.
Our sources give a handy step-by-step guide to get you started.
Yeah, they lay it all out.
It starts with choosing your strategy based on everything we've discussed.
Right.
Goals, time horizon, risk tolerance. Then it's selecting a broker, opening an account, and funding it.
Thorough research is key, and compare different options before making any decisions.
Our sources also has some words of caution. Don't just rely on social media for investment tips.
Yeah.
It's easy to get caught up in the hype. But what works for someone else might not be right for you.
It's like choosing a restaurant based only on Instagram photos. You might end up with something that looks good, but doesn't taste that great. Independent research, reading analyses, making informed decisions, that's what's crucial.
And speaking of informed decisions, our sources really emphasize diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, like stocks, bonds, and mutual funds.
And across different industries, too.
Think of it like a safety net. If one sector takes a hit, the others can help balance things out.
Okay, I know starting to invest can feel kind of overwhelming, especially with all this new information. So let's tackle some common questions beginners often have, straight from our sources' FAQ section.
Yeah, let's clear up some of those initial concerns. Knowledge is power, and understanding the answers will give you the confidence to move forward.
First up, are fixed deposits or money market funds considered investments? That's a great question. While they are relatively low risk, for preserving your capital, they usually offer very low returns, often barely keeping up with inflation. So they're more about safeguarding your money than really growing it.
So maybe not the best choice if you're looking for substantial growth. Next question. How do I figure out the right amount to start investing with?
That's where your personal finances come in. You need to look at your income, expenses, and existing savings. The golden rule is to invest only what you can afford to lose without impacting your financial stability.
Makes sense. Start small and build from there. And finally, what factors should I consider when choosing an investment firm?
That's an important one. Look for a firm with a solid reputation, a platform that's easy to use, fees that are transparent, and a good track record of customer service. It's also important to consider the range of options they offer. Make sure they line up with your needs and goals.
So much to think about. We've covered a lot in this first part of our deep dive, laying the groundwork for your investing journey. But we still have more to explore.
Oh yeah, for sure. We'll go deeper into specific investment strategies and practical tips for the market in our next session.
I'm looking forward to it.
Stay tuned. Welcome back.
Yeah, I'm excited to keep going with this deep dive into investing.
Me too.
Last time we talked about a lot of the basics, like setting goals and understanding risk, and all the different ways you can actually invest. Now I'm ready to get into the practical stuff, like building a portfolio.
Perfect. One thing that our sources really focus on is informed decision-making. It's not just about picking investments randomly. It's about understanding why you're choosing what you're choosing.
So less about hunches and more about doing your research,
Okay.
making smart moves.
Exactly. Remember those different ways to invest we talked about?
Yeah.
Direct trading,
Yeah.
managed portfolios, all those,
Yeah.
no matter which one you go with. A key principle is diversifying across different asset classes.
Okay, but what does diversification actually look like? When you're putting together a portfolio,
Imagine your portfolio is like a pie. Each slice is a different type of asset, like stocks, bonds, or mutual funds. Our sources say to spread your investments across these categories because each one reacts differently to what's happening in the market.
so not putting all your eggs in one basket.
Exactly. Let's break it down a bit more. Stocks, for example. They represent ownership in a company. They have the potential to grow a lot, but they can also be really up and down.
So that's where that higher risk, higher reward thing comes in.
Yes, exactly. Bonds, on the other hand, are more like loans. You're making a loan to a government or corporation. They tend to be more stable than stocks, but they also don't offer as much in terms of returns.
So it's a trade-off, growth versus stability.
Right. And then we have mutual funds, which our sources describe as a basket of different securities. It's like a ready-made diversified portfolio.
So instead of buying individual stocks in a bunch of companies, you could invest in a mutual fund. That holds stocks from all sorts of businesses.
Exactly. That's one way to diversify within a specific asset class. And it doesn't stop there. Our sources also suggest diversifying across different industries.
So not just tech companies, but also things like healthcare or renewable energy.
Exactly. The idea is that different industries perform differently, depending on the economy and other factors. So if one sector is struggling, your other investments can help lessen the impact.
That makes a lot of sense. So whether you're managing your own investments through direct trading or working with a pro with a managed portfolio, diversification is key.
It's a fundamental principle. Here's another important thing our sources bring up: avoiding impulsive decisions.
Oh, yeah, I struggle with that. It's so easy to react emotionally, especially when the market is going crazy.
It's human nature, but you have to remember that investing is a marathon, not a sprint. Those short-term ups and downs are totally normal. Don't panic and sell everything just because the market dips.
Easier said than done, though. How do you stay calm when things are going haywire?
Our sources recommend having a clear investment plan and sticking to it. Even when things get tough, it's like your roadmap. It guides you towards your long-term goals.
I guess that's where the idea of time horizon comes back. If you're in it for the long haul, those short-term dips don't matter as much.
Exactly. It's about the big picture, not getting caught up in those little bumps in the road.
Our sources talk about some of the psychological aspects of investing too, which I found really interesting. They say that our own biases can sometimes lead us to make bad decisions.
Oh, absolutely. Have you ever heard of confirmation bias? It's this tendency we have to look for information that supports what we already believe, even if it's not totally accurate.
Oh, I'm definitely guilty of that. Like if I think a certain stock is going to take off, I might ignore any bad news about it and just focus on the positive stuff.
That's a classic example. Another common bias is loss aversion, where we feel the pain of losing money much more strongly than the pleasure of gaining the same amount.
So we might be too careful or miss out on opportunities because we're so afraid of losing.
Exactly. These biases are part of how our brains work, but understanding them can help us make better decisions.
So how do we fight those biases and keep our emotions in check?
Being self-aware is a good place to start. Recognize that these biases exist and actively seek out different perspectives and information. Don't be afraid to question your own assumptions.
Maybe get a second opinion from someone who can be more objective.
Exactly. A financial advisor or even a friend who knows about investing can give you some really valuable insights. One last thing from our sources that I want to mention is the importance of always learning.
You mean staying up to date on what's happening in the market and new investment strategies?
Exactly. The world of investing is constantly changing, and you have to stay informed, read financial news, attend webinars, maybe even take some courses to deepen your understanding.
So it's not just a set it and forget it kind of thing.
No way. The more you learn, the better you'll be able to navigate the market and adjust your strategies as needed.
I'm starting to see that investing is more than just numbers.
Oh, for sure.
It's about learning and growing your financial knowledge.
I couldn't agree more. Speaking of growing our knowledge, I have a thought-provoking question for you, based on something our sources mentioned.
Okay, you've got me hooked. What's this thought-provoking question?
Well, we're wrapping up this deep dive. You're about to start your investing journey. It got me thinking. What's your own philosophy when it comes to money and investing?
Huh. That's a really good question. I haven't really thought about it before, but it's definitely something worth thinking about.
Yeah, it's about figuring out what drives your decisions. Is it just about making as much money as possible? Or is it more about aligning your investments with your values, supporting companies that do good things?
Now that you mention it, one of our sources talked about socially responsible investing. They called it impact investing, putting your money where your heart is.
Exactly. And there are more and more options all the time. You could invest in companies focused on renewable energy, sustainable agriculture, or even social justice initiatives.
Yeah, it's an interesting idea, combining your financial goals with making a positive impact.
It's a growing trend for sure. People are looking beyond just the numbers and thinking about the bigger picture, like ethics and the environment.
It's about making sure your investments reflect what you believe in. I can see why that's appealing.
So as you take those first steps into investing, keep that question in mind. It might help you make choices and guide you toward investments that really resonate with you.
That's great advice to start with. What other key takeaways would you want our listener to remember?
I'd say the most important thing is to define your why. What are your goals? What's driving you to invest? Once you know that, it's like setting your compass.
Yeah, having a clear destination.
Exactly. Next, never stop learning. Read, research, ask questions. The more you understand about the markets, the better decisions you'll make.
And don't be afraid to ask for help. A financial advisor, a friend who knows about investing, even some online resources can be really helpful.
Absolutely. There's a ton of information out there. Just make sure you trust your sources and think critically about what you're hearing.
Our sources also talk about the importance of patience. Investing is a long game. It's about staying focused on your goals and trusting the process, even when things get tough.
Don't let those short-term market swings get to you. Slow and steady wins the race. And of course, Diversification is key. Spread your risk. It's the best way to handle those ups and downs.
Great advice. We've covered so much in these 3 deep dives. I feel like our listener is ready to start investing.
Yeah, we've gone over the fundamentals, different ways to invest, even the psychology of it all.
I hope our listener feels empowered to take that next step.
I think they do. Investing isn't just for the rich or the experts. Anyone can do it, with the right knowledge and support.
So to our listener, we say go for it. Invest wisely. We're rooting for you.
And remember, the journey is just as important as the destination. Enjoy the process.
That's a great way to put it. Until next time, happy investing.